An investor by the name of Luke with his secretary walks in and meets the CEO of Veritas Limited, Mr. Richard. He walks them into the conference room of Veritas headquarters building. As they continue to walk in, financial analysts from Veritas Limited share notes amongst themselves with regards to the findings on Zanaco Bank PLC. Immediately the investor is in the conference room, Mr. Richard begins to introduce him to the financial analyst tasked to analyze the feasibility in investing in Zanaco Bank. After he's done with the introductions, Mr. Luke excitedly asks everyone to take their seats. Mr. Richard then gives a brief to Mr. Luke on the heavy research and analysis conducted by the well-able financial analyst team. Mr. Luke then asks for the first analyst from Veritas to share with them what their findings are. The first analyst, who is Mr. Darlington, shares with the investor the background of Zanaco PLC, highlights on the overview of the 4 indicators of the bank, which the rest of the team will be able to give detail. Speaking to Zanaco's income statement is Chitua, in which she indicates the performance of the company. Speaking to the balance of the company is Fredo, who highlights the position of the company, as the investor is intrigued to hear more of the company. Lastly, Mr. Joseph speaks on the cash flow statement, which highlights the company's uses of cash source and where they are much concentrated. In conclusion, Mr. Richard gives a summary on the findings in a way that allows the investor to make a decision on whether to invest or not. Mr. Richard surely indicates to the investor that the findings of Veritas on Zanaco's position in an investment opportunity do not favor the decision of proceeding to invest. Mr. Luke, who is dismayed by the findings of Veritas, nevertheless, he expresses his gratitude for the work put in by Veritas in helping him make a full sound financial decision. We now share a full report on the performance and position of Zanaco PLC for the years 2021, 2022, and 2023.
Hi, my name is Darlington Angoma, a student at the University of Zambia. The name of our company is Veritas Advisory Limited. The purpose of our company is to analyze the financial statements of Zanaco for the years 2021, 2022, 2023, and provide a report to our investor on whether to invest in Zanaco or not. So to start with, here is a table of content on how we shall move. So we have the executive summary, the introduction, the accounting framework comparison, and the profitability ratios, the liquidity and solvency ratios, the efficiency and activity ratios, the common size statement, and lastly, we will talk of the recommendations in conclusion. So, introduction. Zanaco operates in the banking and financial service sector, providing a variety of products from corporate and investment banking to retail, SME, and digital services. It maintains the largest national network in Zambia, covering about 60 branches, approximately 200 ATMs, and over 21 Zanaco Express agents, reaching all 10 provinces. However, the bank is a pioneer in digital channels, serving millions via mobile and online platforms. It also leads in sustainability by the Global Climate Fund and active in green financing, solar paneled branches, and climate resilient programs. History. Zanaco was established in 1969 to service the financial needs of the Zambian economy. However, in 2007, the government of the Republic of Zambia sold a 49% stake in the bank to Rabo Development BV, a subsidiary of the Netherlands. However, subsequently, Rabo Development sold a 3.41% stake to Desire Investment Limited, a nominee of the Zambia National Farmers Union, following the bank's initial public offering in 2008. The bank remains majority owned, as we have seen, by Zambians and thus considered citizen owned, a relationship which with the IBV enables Zanaco to benefit from technical assistance and best practices in various areas of banking. So we now move to the accounting framework comparison. So under the accounting framework comparison, we have two sets of accounting frameworks. We have the IFRS and the US GAAP. IFRS stands for the International Financial Reporting Standard, and the US GAAP stands for the United States Generally Accepted Accounting Principles. So when we are looking at Zanaco's financial reports, which follows the International Financial Reporting Standard, you need to remember they can be different from a US company reports which follows the US GAAP. So these differences matter for anyone trying to decide whether to invest in Zanaco, like for an investor in it, for instance. So here are the main items to keep in mind. So how does Zanaco recognize its revenue? So under the IFRS, Zanaco recognizes revenue when it gives a customer a product or a service. The rules are more general. However, under the US GAAP, US companies also use a similar process, but their rules are often more specific for certain types of businesses. But then what does this mean for an investor? So you might see small differences in how Zanaco reports its income compared to a US bank, which could affect how you compare their growth and profits. We move to leases. How does Zanaco recognize its leases? So under the IFRS, Zanaco puts almost all its leases, like for instance, office buildings, on its balance sheet as an asset and a debt. However, under the US GAAP, US companies divide leases into two types, and we know that we have two types of leases, operating and financing, which give it a different views on how they're recognized. So what does this mean for investors? Zanaco's balance sheet will look like it has more assets and more debt than a US company with the same leases. This can make its debt to equity ratio look higher, so you have to be careful when comparing. We move to the asset impairment. So how does Zanaco recognize asset impairment? Under the IFRS, Zanaco checks if an asset's value has dropped. So if it has dropped, they can write down the value and later, when it goes up, recognize the value. However, under the US GAAP, US companies have a more detailed process for this. They can write down an asset's value, but are not allowed to write it back up later as the IFRS does. So what does this mean for investors? Zanaco's profits might go up and down more easily with changes in the economy because it can reverse a write down. This is a key difference when you're looking at the quality of a company's earnings. So lastly, we look at the research and development, how Zanaco recognizes research and development. So under the IFRS, Zanaco can count some of its development costs for new products, like a new banking app, as an asset on its balance sheet. Under the US GAAP, US companies usually have to count this cost as a regular expense right away. So what does this mean to our investors? Zanaco must report higher profits and have more assets on its balance sheet than a US company that spends the same amount on research and development. This makes it harder to compare their profitabilities and total assets directly. In conclusion, Zanaco's IFRS-based financial statements differ from the US GAAP in key areas such as revenue recognition, as we saw, leases accounting, assets impairment reversals, and lastly, the research and development capitalization, all of which can distort direct comparison with US companies. These differences may lead to variations in reported earnings, debt levels, and asset values, making Zanaco appear more or less profitable or leveraged than a US peer with similar operations. Therefore, investors must carefully analyze these accounting distinctions, particularly the flexibility impairment reversals and the capitalization of development costs, to accurately assess Zanaco's financial health and performance. So by adjusting for these discrepancies in scrutinizing financial statement disclosures, investors can make more informed decisions and avoid misleading conclusions when evaluating Zanaco as a potential investor. We now provide an overview of the performance of Zanaco using the profitability ratios. Under the profitability ratios, we have the return on equity ratio, the net profit margin, the gross profit margin ratio, and lastly, the operating profit margin. So, what do these profitability ratios tell us? So, the profitability ratios such as return on equity, net profit margin, and gross profit margin and operating margin could be used to assess the bank's ability to generate earnings relative to its revenue, assess assets or equity. These ratios will help our investor to evaluate how efficiently a bank converts its services into profits and how well it utilizes its resources to create value for our investors. These ratios were helping our investor understand Zanaco Bank's performance operational efficiency, and ability to withstand economic fluctuations. So here we now present to you the comparison of profitability ratios from 2021, 2022, and 2023, as you can see. So we start with the return to equity ratio. So the return to equity ratio declines from 48% to 42%, which suggests reduced profitability relative to shareholders' equity. So while still high, the drop may indicate slower growth or increased capital. It's not necessarily bad, but sustained decline could signal weakening efficiency in generating profit. So the rising net profit margin, which is the second one, shows Zanaco is becoming more efficient at converting revenue into profit, indicating improved cost control or higher income. Thirdly, the gross profit margin drop in 2022 suggests higher cost or lower income efficiency, but the recovery to 65% in 2023 indicates improved cost management or revenue growth. So volatility may reflect operational or market challenges. Lastly, the sharp drop in operating margin in 2022 signals increased operating costs or reduced efficiency, while the 2023 rebound to 26% shows partial recovery. Overall, this indicates operational instability but signals of improved efficiency. We move to the bank's position. So to analyze the bank's position, we use the liquidity ratios and the solvency ratios. Under the liquidity ratios, we have the current ratio, the quick ratio, which is also known as the asset test ratio, and lastly the cash ratio. And under the solvency ratio, we have two ratios, which we shall show here, which is the debt to equity ratio and the interest coverage ratio. So what's all about the liquidity ratios? So the liquidity ratios were used to assess a bank's ability to meet its short-term obligations and withdrawal demands from deposits without running into financial distress. The ratios like current ratio, quick ratio is crucial because the bank must have enough liquid assets to handle withdrawals and interbank obligations. On the other hand, solvency ratios were used to evaluate a bank's long-term financial stability and its ability to meet all obligations, including debt and other liabilities over the long run. Solvency is crucial for regulatory compliance and maintaining confidence in the financial system. So here's an overview of the liquidity ratios, as we can see. So let me explain the liquidity ratios that have been shown in the previous study. So the bank had a strong cash position, able to cover 72% of its current liabilities, and it dropped in 2023 to 52%. A cash ratio of 53% is not bad, but a trend in declining liquidity should be monitored closely. Banks don't keep cash, but instead invest it, which is a good thing. In 2021, however, the bank had a strong near-term liquidity ratio. It could cover 70% of its current liabilities with highly liquid assets. The quick ratio is still below the required ratio of 1.0. In this case, the bank does not fully recover its current liability, sank the most liquid assets. However, it didn't calculate the average industry average. Using the most liquid asset, it can be shown that the bank is not very better able to cover its current short-term obligations. So we move to the comparison of the solvency ratios, which are the debt to equity ratios and the interest coverage ratios. So the decreasing debt to equity ratio over 3 years shows improved financial instability and lower risk. A DE ratio of around 1.06 in 2023 is relatively balanced. The bank is not overly reliant on debt, which is generally attractive to conservative investors. So as the debt to equity ratio decreased, the interest coverage ratio increases, which indicates the bank is managing interest rate better. This gives us a picture that the bank is becoming less reliant on debt. We move to the efficiency and activity ratios. So the efficiency and activity ratios, as we know, are calculated from the balance sheet, which is the financial position of the company. So we have the asset turnover ratio, the inventory turnover ratio, and the receivable turnover. So what do we talk about when we are looking at the efficiency and activity ratios? So under the efficiency ratios, we assess how well the bank manages its operation over the last 3 years, 2021, 2022, and 2023, as relative to its expenses, indicating cost control and productivity. Efficient banks can deliver better profitability and services with lower cost. We also consider activity ratios, which were part of the efficiency ratios, which were used to measure how efficiently a bank uses its assets to generate income, which is the main purpose of the bank, is to generate income. So this ratio helps to analyze how well the bank was deploying its resources to generate returns. So the bank becomes less efficient in using its assets to generate revenue. It can be seen that 2022, so the efficiency and activity ratios were calculated. So the bank becomes less efficient in using its assets to generate revenues. It can be seen that 2022 and 2023 were as no deterioration and also no improvement. This suggests the bank is generating less revenue per unit of assets in its previous years. The bank collected 0.91 times its receivables, a relatively low turnover, suggesting slower collection or longer term holding. 2022 it increases, which suggests that the bank was a bit faster in collecting its outstanding debt. A sharp drop in collection was observed for 2023. So now we have the common size statement for 3 years. So we start with the common size income statement for Zanaco for the years 2021, 2022 and 2023. But then the full report is presented in the handout that we provide. So here is a common size income statement. Here is a common size balance sheet statement for Zanaco. And lastly, here is the common size statement for Zanaco, common size cash flow statement for Zanaco for 2021, 2022 and 2023. However, our key interest is to look at the key trends in operating cash flow, investing cash flow, and lastly, financing cash flow. So we start with the operating cash flow. So the operating cash flow is expressed as a percentage of cash flow from operating activities. So what were the key trends in operating cash flow? So the first one was loans and advances. As we can see, statutory deposits, customer deposits, other liabilities, fair value adjustments. So what does this tell us? So customers have significantly increased in 2023. Customer deposits have significantly increased in 2023 from 150.66% in 2021 to 417.13% in 2023, indicating that customers place a high value on the bank and they trust the bank to keep their money, which is a liability to the bank, has been given out as loans in 2023, amounting to approximately 43.7%. So we move to the cash flow from investing activity as a percentage of operating cash flow. So what were the key indicators? The key indicators were proceeds from maturities of government securities, proceeds from sale of total assets, and investment in trading assets. So what does this tell us? So investing activities illustrates that the bank has been using its cash for investing in trading assets, and also we observe a high return on proceeds. So we now look at the cash flow from financing activities. So what were the key indicators of the cash flow from financing activities? Were the repayment of borrowing, the proceeds of borrowing, and the dividend paid. So financing activity shows that much of the cash flow was from repayment of borrowing. And also, lastly, the dividend that were paid increased from 3.43% in 2021 to 42.18% in 2023. These were like the key drivers of financing activity in the bank. So, what are our recommendations and suggestions? Before we give the recommendations and suggestions, what was the core problem? So the core problem arises in the earnings quality collapse. So the most critical issue is the catastrophic divergence in 2020. The first one is the profit before tax, which soared to 2.7 million. Second is the operating cash flow, which collapsed to a mere 16 million. This means that for every quarter of profit Zanaco reported, it generated almost no cash. This is a hallmark of extremely low quality and sustainability earnings. The profit is an accounting illusion, not a measure of real financial health. So the primary red flags and their implications. So the first one is the massive aggressive accrual. The most likely culprit is a huge increase in loans and advances to customers, as shown in the cash flow statement. This indicates Zanaco lent out a large amount of money in 2023 to generate income, but those loans have not yet been paid back in cash. This is incredibly risky. If these loans default, massive losses will occur. The second is potential one-off or accounting choices. The surge in annualized exchange differences and fair value adjustment suggests significant non-cash gains and losses that heavily inflated the profit figure. This adds volatility and makes the core performance impossible to see. The third one is the deteriorating liquidity. The cash ratio dropped from 72% to 52%. While a bank doesn't hold pure cash, this sharp decline confirms that the liquid assets are being stretched thin to fund this aggressive growth. The last thing was high dividend pay out amidst cash crisis. So paying out 42.1% of cash flow as dividends while operating cash flow is virtually zero is a major warning sign. It suggests management is prioritizing shareholder appeasement over prudent capital management, potentially weakening the bank's crucial financial health. So the last one was high dividend payout amidst cash crisis. Paying out 42.1% of cash flow as dividend while operating cash flow is virtually zero is a major warning sign. It suggests management is prioritizing shareholder appeasement over prudent capital management, potentially weakening the bank's financial position. So the final recommendation we give to our investor is do not invest in this bank based on the 2023, 2021, 2022 analysis. In conclusion, analyzing a bank is not just about looking at the numbers, it's about understanding the story behind those numbers. We have examined the bank's financial health, including its profitability, liquidity, and risk management, and how these elements interact to impact overall performance. This analysis highlights areas of strength that the bank can build on and potential risks that require careful monitoring. Ultimately, a thorough bank analysis equips stakeholders, investors, regulators, and management alike with the insight needed to make informed decisions. Thank you for your attention, and I hope this discussion provides a solid foundation for assessing banks' performance in the future.